Hi, welcome to Market in a Minute. Well, the world's being trumped, and so is the stock market. The stock market's loving it. So, Trump's policies are getting put in place, and they all look pretty good. I gotta say, I was really negative when he first started the tariffs, but he turned that around, and it looks like a really good plan. So, the market, we're gonna do a little checkup, like going to the doctor. We see some good and some bad, and we need to fix some things. The market update. So the everything that Trump's doing should have a really positive impact over the years. All the capital that's coming into the United States, or at least is planning on it, it's staggering. We're going to have such a strong production profile in our country. It's going to help the budget deficit. It's going to bring down the budget deficit significantly. It's going to expand growth. We'll see what it does to the stock market's multiple. I don't think the stock market multiple can really go a lot higher than what it is currently, but it might. So the sentiment is actually contained. I figured by this time, with the market up so strongly off the bottom, we'd have pretty bullish sentiment, but it's pretty even. Let me show you that real fast. So the investor sentiment, this is as of the 23rd, is roughly 37% bulls, 34% bears, and the historical average is about 37.5% bulls and 31% bears. So if anything, we could go if the sentiment keeps going up in terms of more bulls and less bears, the market could really go nicely higher. So it bottomed out, at 60, almost 62% bears in April 2nd. That was the bottom of the market. Now we're only at 34% bears. So big shift. The market's up big, but there might be more to go in terms of investor sentiment driving the market up, and also the meme stocks. The meme stocks are starting to come back into favor and are flying. That's generally not a good sign. When the meme stocks are really doing well, it means we're probably closer to the end. The valuations of the market, the S&P 500, 22.7 times 12-month forward earnings. Let's take a look at that real fast. So we're way up here now. We're back above the most recent high. So 22.7 is a very full multiple for the stock market. But there is something happening. It appears that earnings are starting to accelerate rather than decelerate like they have been. But just keep in mind, we got down to roughly 18 times earnings earlier this year. Now we're at 22.7. That's a long ways. And just recall, into the year 2000, before the crash because of the tech bubble, the PE multiple on a forward 12 months was 24 times. So I don't think that the multiple can go a lot higher. If it just stays the way it is over a 12-month period, we should get about by year's end, we should get about a 7% return from this level as the earnings come through. Looking out to next year, 302, 302 at 22.7 times. That gets us the 7% growth by year end. So that'd be 12 months forward at that point. The market generally tracks earnings, right? So let's look at that. Here's the market in blue, the earnings in black. And so we can see the market is nicely above the earnings trend. So it got to a high level and towards the end of 2024. Now we're above that level. You can see that red line is a little higher than the previous red line. So that spread between the earnings growth and the price of the S&P 500, it's at a pretty high level. So we don't think there's a lot more left in that sort of indicator. And then going back on the earnings themselves. So earnings themselves have been coming in better than expected. So for this quarter, like we anticipated, better than expected. We got what we're looking for. Stocks responded. Now we're getting closer to the end of reporting season. We still have a couple more weeks. And then we're looking at 2026, and 2026 is looking a little better as well. So let's look at that really quick. So here's the earnings expectations. You can see how it's come down in a huge way for 2025 over time. Big downward cut to earnings expectations, and that's generally what happens, but that's a really big cut in terms of the expectations. Now it's starting to go back up the other direction. It's not going to go up a lot, but the trend is looking better. We got down towards the 26 $262, $263 was kind of the low. Now it's $265 for the 2025 expectations. So that's a nice trend. And then 2026 was 300, now it's 302. And if you look at what's happening, what sectors are doing well. Well, we've had some technology reports, not a lot, but we had some. We were looking really closely at the semiconductor stocks last week and, looking for a cyclical pickup. We didn't get it. I would call that disappointing for the markets. But with everything Trump's doing, maybe it masks the slowing or the lack of a pickup in the semiconductor, cyclical side of their business. Financials doing well. So that's been a good group. And let me show you that. So here are the 11 sectors of the S&P 500. Energy wasn't as bad as everybody thought. That's generally what that is. It's not really huge, really big improvement in the business. It's just that the estimates got too low. Those stocks should be okay, I'd like to have at least a market weighting there. You never can tell what may happen on the geopolitical side. Financials had really good quarters. Their stocks didn't respond, so a little concerning. Consumer discretionary, D.R. Horton had a good quarter. Stock popped. We got in here and we actually sold it. So we think it's probably going to 180 over time, but it's not going to be a straight line, and we think we can buy it back cheaper later. So consumer discretionary, we like this group to fish in. This is a good group. And so we like the specialty retailers in this area. Our favorite's Gap, but we also recently bought Abercrombie & Fitch and a couple others, one being American Eagle and Urban Outfitters. So American Eagle, it's nice to have some memory response to it, right? So, that one shot up about 20% recently, as there was a nice model that they hired to, model their jeans, and evidently she's pretty popular. The tech earnings, as I mentioned, I'm disappointed in this group here. Actually, and 3% higher on healthcare versus expectations. That's nice. This is a sector that's completely out of favor. It's at its low historical multiple relative to the markets, and we're starting to see kind of an upward trend here. Now, it's not like it's going to be a huge upward trend, but the estimates are probably too low. One more thing on the consumer discretionary. I think what's going on, like in terms of Gap, we'll see what Gap reports here in a few weeks, but what's going on in that sector is that the estimates got cut in a big way because of tariffs, and I think that they got overly cut because of tariffs. I don't think it's going to have the impact, so it's going to swing back the other direction. The technicals are strong, maybe a little bit too strong. So let's look at the S&P 500. So obviously bottom in April, huge run, right? Broke all the moving averages on the upside. It's above the 20-day. So this is a nice trend. We like the trend here. We like when things are trending above all the moving averages, and that's what's happening. However, it's nicely above the moving averages. So what most tactical managers do is they get all concerned. They get concerned after it breaks the 200-day, and they react to it. We're so far up here. How our strategies work is as we break these moving averages, we get more and more defensive, and then we hedge the portfolio completely as it breaks the 200-day. So we have some nice cushion in front of us. What we're doing on individual stocks is we're taking profits. Excuse me. So we're selectively taking profits and starting to hedge the portfolio a little bit. So in one of our strategies, well, a couple of our strategies, we put a hedge in place. So our tactical growth, a little bit more aggressive. We put a little bit of the NASDAQ short in there. We'll do it in 3 stages. So that was the initial stage. So not a big position yet, but that will grow over time. And then our healthcare, absolutely huge winner this year. It's been a beautiful move. Could be one of those huge years. However, it's moved so much in the short term, and our stocks are going to be driven off of what happens to them fundamentally. So we got some key data points coming up, and I'll go over that in a second. But that should drive those stocks higher. I just want to protect it from a downdraft in the overall market. So we put a little inverse of the XBI in the portfolio, the NASDAQ inverse of the biotechnology sector. The Fed meets Wednesday. Important, really important. It's critical that they set the stage to cut rates in September. If they don't, I wouldn't want to be in the crosshairs of Trump. I think it would be really disappointing for Powell to have to deal with that. So I think he's going to set the stage to cut rates in September, and so that should help the markets again. But if it doesn't happen, I think it's going to be a big negative. What have we been doing? This is a biotechnology company, Capricor. They have a really interesting drug. It's for Duchenne muscular dystrophy. They've had some issues with the FDA, but I think they're going to approve this after the data is released in August. So this could have a very big move. So these are the pipelines. This is a closed-end fund, yields about 8%, trades at a big discount to the NAV. Baxter, I mentioned this last week. We bought it. It's up, not quite 10%, but they report this week. I think the report's going to look good. And then the drug group itself, biggest position there is Lilly. I like Lilly. It's a closed-end fund, has a very nice yield on it. I mentioned Gap, and I mentioned we sold D.R. Horton. So now, if you would oblige, we're going to talk about the PVG strategy. So many people ask, I need to get PVG asset management. All of our strategies are on that site. You can get a tear sheet. So the PVG performance overview. So we put, this is our best portfolio this year, and I want to highlight it a little bit. We've been talking about this, how we do a good job on picking stocks in the biotechnology sector. Actually, these returns are quite remarkable. So we're up over 900% since 2012. 900%, and the index is up roughly 300%. So we've been doing a really good job picking stocks. We look for those companies that can have a 5 or 10x upside, and we've been pretty successful on picking these. So just want to highlight some of the performance of our strategies. We had a really decent quarter in the second quarter. This quarter starting off well as well. Our emerging healthcare strategy, that is lightning in a bottle. Okay, that's lightning, and then thunder is right below it. The tactical growth. The tactical growth is it's a great tactical portfolio. It does about a 20% average annual return. This is the benchmark. This is the Morningstar aggressive tactical portfolios that we compete with. You can see we're nicely above our competitors. So really strong performance, and we have the downside protection too. So for an aggressive investor, these two portfolios, maybe do like an 80-20. That's over time. Give me 5 or 10 years, and you're going to have, hopefully, if everything goes well, if the world doesn't come to an end, right? Everything goes well. We don't have a depression. These portfolios should be really nice returns, compounders for us. Dynamic Core. Okay, this is a more conservative strategy. It's Morningstar peers. We're beating that quite a bit. This is just the S&P 500, and we risk manage it. And then our tactical total return against its similar benchmark. That's probably our most conservative strategy besides our loss-averse equity income portfolio. But let me show you some of the performance. So tactical growth, you can see average annual return almost 20%, beta of 0.83. So we're getting really nice returns, but it's below the market beta itself. Dynamic Core, this is the S&P tactical portfolio, 8.5. But look at the beta, 0.35. So any investor could own this. So this is a nice portfolio. It gets good returns, and it's got really good risk management associated with it, along with tactical total return. Again, 0.34 beta. You can see these betas are quite interesting. Emerging healthcare, big returns. The aggressive, moderate, conservative, and income and absolute return, these are kind of set allocations. So aggressive is 80-20, but then we modify the 80-20 mix as we see it being appropriate to do so. Again, a little bit of aggressive portfolio, beta 0.66, almost a 16% return, moderate, kind of consistent with those returns, all the way down to income. Income, we got nice returns. Actually, we think our returns are going to be higher now, given that the level of interest rates are much higher since we started this strategy. But interest rates are higher, we can get nicer returns. Those baby bonds yielding 8% are really attractive, and you got a nice low beta. So I wanted to walk you through our philosophy, why we're loss averse. It's so important to understand this. These numbers are going to blow you away. So this is a cartoon depiction of our dynamic core strategy. So the S&P 500. We're the black line, right? The green is the S&P 500. And then when, like, say, for instance, this is 2008. When we break the 200-day moving average, we're locked down. We've got it hedged, right? And so as you go through this cycle, the market falls quite a bit, like it fell about 40%. And then, hopefully, which we did, we're going sideways. So we're going sideways through this period. Actually, the dynamic core was off about 5% in 2008. And as you know, the S&P 500 was down close to 40% that year. So we're going sideways in a downward falling, bear market, and then we reinvest as we start to come out of it. And these are not levered numbers. This is just compounding of money as the markets go up. Now we're at a top, somewhere around the top of the markets currently. Maybe extends for a couple more years, but maybe we roll over too. So we could easily see a 5 or 10% pullback in August, September. Such good news in the overall markets, but we have some probably sentiment to still run the markets a little bit anyway. But what we could see is this pullback. We want to keep these gains, right? If we had perfect timing, okay? Barron's thinks I have perfect timing. They wrote an article about this, years ago, and I'll show you some of the quotes. But if we had perfect timing, so you can see here, this is from 1996. Big up move, back down. So you lost everything you gained from 96 and bottomed out in 2002. You lost everything you gained. So if you had perfect timing, you're out here, you're in here, you're out here, you're back in here. That's what we want to do. Okay, in here, out there. Okay, and then back in here. So there's not that many trades here over a very long period of time. So if you had $1 million and you invested it in 1996, your portfolio would have been about $5 million. And this is as of September 30th, 2023. Okay. If you had perfect timing, okay, this is the beauty of not going down and compounding money. You would have had $61 million. Crazy, huh? Well, that's what we want to do. So you can see this tactical growth portfolio. If you grow at 20% a year, you're going to have these type of returns. So, as long as we can hedge that portfolio when the market drops, we're going to get really big returns. So our philosophy is to protect the downside during bear markets, but also get really good returns when the market's going up. We provide separately managed accounts to investors, or UMAs, United Managed Accounts, to advisors. And so an individual could get these type of portfolios through their investment advisor. Now, if you're an individual and you want to come us to directly, you can do that as well, as long as we're not competing with some of the investment advisors that we work with. But so we provide separately managed accounts for institutional investors, financial advisors, and individuals. So our tactical strategies, they're different. They're different from the typical tactical manager. Our goal is to protect the portfolio, not to be aggressive all the time, but to protect that portfolio and to be proactive, not reactive. So start to do it earlier rather than reacting to roughly right now an 8 to 10% drop in the overall market before you do anything. So making money in rising markets, most every manager can do that, right? It's not hard. Every individual can do that as well. But protecting your portfolios during declining markets, we think we did that really well. So we have the combination of the two. Just remember, we hate to lose money. So that's the most important thing, is to not lose your money and allow that money to compound over time. Those positive returns compounding over time. Even if we're going to get a 5%, that's a lot better than being down 5%. So as those things compound over time, never get a 40% decline. So we really want to avoid those major declines in the overall stock market. Compound positive returns over time gets you really nice returns without risk, a lot of risk, I should say. So we don't like taking unnecessary risk. You don't have to do that. So we have 6 portfolio managers. 4 of us work on the GIPS composites, meaning the strategies I just showed you. There's 4 portfolio managers on those. GIPS means it's a verification you get by an auditing firm annually. It's called Global Investment Performance Standards. It's really important. If you're going to hire a money manager, make sure they are GIPS verified. So the returns that we show you, they're real returns. Okay, lastly, that's me. A little bit of background of me. I have my MBA like probably everybody else, and a CFA, and graduated from The Ohio State University in finance and accounting. In my work experience, I worked for some of the larger mutual fund companies managing their flagship portfolios. My last job was with the Berger Funds prior to coming to PVG and buying PVG. But I was at the Berger Funds for several years, having great performance. And then prior to that, I was at Kemper in Chicago, managed their flagship portfolio. And then I was at Founders Dreyfus, also in Denver, like Berger, and had one of the best performing balanced funds. So risk managed, right? Had one of the best balanced funds for 3 years running. I was the top balanced fund manager. So Barron's coined the phrase that I had all the right moves in an article and perfect timing. I wish I had perfect timing. We have good timing, but not perfect. I think hopefully you found this helpful. If you have any questions, just reach out to us. We'd love to set up a call and see if these portfolios fit your risk profile. Thank you very much.